the conversion process, if it has been done in the middle of the year, and from a tax point of view, depreciation for the current year needs to be prorated on the basis of the number of days the assets were used by the predecessor versus the number of days the assets were used by the successor. Again, when we come to the relevant provision little later, we will discuss some more technicalities, more granular details on how the provision actually applies. In the hands of the partners, the cost of shares allotted in the company will mimic the cost which is there in terms of their capital balance in the books. While we have done a lot of part-time conversions where prior to the part-time conversion there has been a revaluation of the assets of the business, which I still feel is possible, subject to one going through the relevant accounting provisions and accounting framework. But it is a clear-cut point from my side is that even if the assets are revalued, the cost as far as the partners were concerned, that cost will remain the same, and therefore, when the partners get allotted shares in the converted entity, the cost cannot be on the basis of the revalued assets. The period of holding will start from the day when the shares are actually allotted. Going back to the transferee, I think similar provisions. So the first point is what happens to the depreciation for the year. The sixth, as per the sixth provision of section 32. Again, pro rata on the basis of the WTV of the predecessor. Clearly, no step up possible, and therefore, even if there is a revaluation, at least in a chapter 21 conversion, no step up in the assets is possible. My belief is that the company will be entitled to all the benefits and incentives that the firm was entitled to. Earlier we had this circular or rather that circular still is prevalent, circular of 1963, though in the context of the amendment that has been brought in section 80IA 12A, there was a further circular which said that this circular of 63 is no longer valid. We have done detailed analysis, and our belief is that in the case of, especially in the case of a corporatization event, chapter 21 conversion, all the benefits which the partnership firm was entitled to, they should continue seamlessly for the balance unexpired period. So if there is a tax holiday which was for a period of 10 years, and the conversion process happens in the 6th year, then the balance 4 years, the corporate entity will get the benefit of the tax reduction. Some case laws are given which you can use on a need basis. An area which is a little debatable is what happens to the losses of a partnership firm. So if the partnership firm had losses, and if you do a chapter 21 conversion, whether the losses also migrate to the corporate entity. Again, my belief is that it might be possible for us to argue that knowing the whole process of conversion, because there is a statutory vesting, even the loss carry forward should be permissible, but unfortunately the way the Income Tax Act is structured, the loss is attached to the SSC, and we might have to make out a very, very sound case to argue that the SSC still remains the same, although earlier it was a partnership firm and now it has got itself converted into a corporate entity. So it is, as far as losses are concerned, I would, it doesn't come as a very natural corollary that conversion chapter 51 will give you the benefit of losses. And therefore, a practical level viability would still be that whatever is the conversion process that you are doing, under the Companies Act, follow the requirements of chapter 21, but also try and ensure that the conversion process also fulfills the requirements of section 4730, and we deal with the relevant provisions of section 4730, because under the tax provisions of section 4713, there is a inbuilt mechanism provided by the law itself which says that if there are unabsorbed business losses, then those losses also get migrated to the converted entity. And therefore, especially in the case where you have losses, you might want to ensure that while you are following the Chapter 21 process, ensure that all the conditions of 4713 are also fulfilled, because then that shifts you from a grey zone to a zone of certainty. Again, for the type of detail that we should be able to provide to the clients. What happens to 43B deductions? My belief is that the 43B deductions will continue. So there is an unpaid statutory liability which is carried over to the company, and the company pays it. The company should be entitled to the benefit of deduction. Same would happen to disallowances under 40A, 40A, IA. Also, in the context of bad debts, we have a Supreme Court decision in the case of Veerbhadra Rao, and the principles enshrined in that Supreme Court decision also will continue to operate. A very interesting situation which we have dealt with, though it's again not in a very certain zone, is what happens to the AMT liability of a partnership firm. So a partnership firm which was entitled to any Chapter 6A deductions is liable to pay alternative minimum tax, which is not same as MAT. All of us know that. So what happens when that partnership firm gets converted into a company? Whatever is the AMT which the partnership firm had paid, whether the company will get the set off of that AMT liability, and if so, on what basis? Maybe two questions that are there. Some pointers that I would want to share with the group is that when it comes to a company getting converted into LLP, and for which there is a separate section called section 4713B, there is a specific provision under 115JAA subsection 7 which says that a company getting converted into LLP, if it has got any MAT and there is a MAT credit, that MAT credit will not get transferred to the converted LLP. So it's a reverse process, company getting converted to LLP. We are dealing with a situation where a partnership firm or an LLP getting converted into a company. If you look at the language of section 115JD, 115JD does not talk of SSC, it talks of a person. So any tax credit or AMT credit of a person will get, a person is entitled to claim the benefit of that tax credit. The definition of SSC versus person, my belief is that it sort of opens some doors for us to argue that the AMT credit of a partnership firm will transfer to a company. And when you actually look at the process under which the AMT credit is claimed, what the law provides is that you get a credit of the AMT when your taxable income is higher than the AMT income. AMT income is your gross total income before Chapter 6A deduction, or your taxable income after adding back Chapter 6A deductions or Section 10 AA deductions. So it's not the book profit that we look at under MAT, it's a different. But what happens is that when you are trying to seek the credit of the AMT paid by a partnership firm in the hands of a company, the company will never have liability to pay AMT, and therefore one of the you get the deduction on the basis of the tax liability being higher than your AMT liability. That AMT liability in the case of a company will always be zero. In one of the cases where a large credit was due on such conversion, we actually went ahead and claimed the deduction. So far it's not got litigated, and as things stand, that credit has actually been allowed to us. Some important pointers is that when you claim a credit of this type, if you look at the penalty provisions under 271(1)(c) or the new section 271(a), claiming a credit never enters into a default which is possibly liable for penalty, and therefore even if you were to go ahead and make such a claim, I am sure at least the penalty provisions will not stick, because if you look at the language of the relevant provisions, everything starts with what is the income. Nowhere there is a discussion on whether a particular amount which is due to you or not due to you, and if you claim that as a credit, also exposes you to the penalty. So I mean, this is a very interesting situation. As I said, not much judicial precedents available. Though there are, I think in some of the later slides we've covered a few case laws where what happens in the case of the general corporate restructuring in cases of amalgamation or demerger. There are at least a couple of reported case laws which say that the MAT credit of an amalgamating company will be available to an amalgamated company, and similarly a MAT credit of a demerged company will also be available to a resulting company. And based on the case law, one would therefore get tempted to believe that the AMT liability or AMT credit of a partnership firm should also be available as a credit to a especially when you look at a Chapter 21 conversion, which is a statutory process, and therefore all the assets and liabilities by default they move from the partnership firm. And MAT credit or AMT credit is nothing but a credit which is available to the partnership firm. It is in the nature of an asset, and therefore that should move over here. I think stock in trade, again, no need to revalue stock in trade on the basis of the market value. You have the decision of Supreme Court in the case of Shakti Trading Company. A very interesting proposition is what happens to the issue of share. The issue of share. So what happens is that you have this provision of section 56(2)(7)(b), which says that when you are issuing shares at a premium, if the consideration that you have received is more than the value of shares, then that difference is liable for tax. What would actually happen is that in the case of a conversion process, you will, assuming the market value of a business is 100 crores, the book value is 10 crores, and if you do the whole conversion, you will have the conversion happening at the book values, and therefore the 10 crores is the value which will get recorded in the books of the company, and the shares will be issued equivalent to the face value of 10 crores, either at par or at a premium. So the consideration that you are actually receiving is the market value of the business, which is 100 crores, and the value of shares that you are allotting is not at the face value of 10. And therefore, whether 56(2)(7)(b) implications arise, my answer is clearly no, because what is the underlying value of the shares is represented by the value of business, and because both, so if somebody is trying to say that the value of business is more than 10 crores, you can very well say that the value of shares also mimics the value of business, and therefore 56(2)(7)(b) provisions will not apply. A major unintended benefit of a corporatization process could be the benefit of lower tax rate of 25% under section 115BA, especially in the case of a manufacturing company. I think there is a subsequent slide which deals with it. Just to sort of give clarity on once the process of corporatization is done, what happens to the cost of shares, and if there is a future buyback from the corporate entity, you have this new rule 40BB pursuant to section 115 QA, where again there is some debate possible. I think we will deal with at the relevant time. I will skip all this because we are running short of time. So in essence, what are the pros and cons? The statutory vesting, no capital gains, no tax liability, continuity of business gets assured, especially if for somebody who's trying to go IPO, then the SEBI-ICDR also deals with this type of situation. Unfortunately, there is no direct tax shelter which is enshrined in the law, and therefore if you want certainty, you should try and get yourself covered under 4730. On subsequent sale of shares, the capital gains will be based on the original cost, no step up possible. So 4713 and 4714, 4713 is for partnership firms, 4714 is for proprietary firms. Again, it's an incentive provision created by the tax regulations to permit and provide an incentive for the entire corporatization process. And the government believes that while there is a tax neutrality provided for corporate restructuring, there was earlier no tax provisions applicable for a non-corporate entity conversion. So the relevant circular is there. There is some provision in the circular which is a little overboard than the required regulations. So I think that part of the circular I would feel is not applicable as yet. So essentially, when you look at a 4713 conversion, all the assets and liabilities of the business are transferred to the company. So 4713 has 5 or 6 conditions, and if you look at each of the condition, what it says in the first condition, all assets and liabilities of the partnership firm needs to be transferred to the company, and therefore you cannot pick and choose some assets. And if you have to pick and choose some assets which should not form part of the conversion process, then you will have to deal with those assets prior to the process of conversion. What the relevant provisions also say is that assets and liabilities, so the succession or conversion, as we popularly call under 4730, is not a succession of the entity. And I would require your attention on this difference, that chapter 21 conversion is a succession of the entire entity, whereas a 4713, again the way it is defined is it's not a succession of the entity, it is a succession for the business of the entity. And therefore you could have a situation where the partnership firm continues, and just to drive home the point is the partnership firm has 2 businesses, and the idea is to convert only one of the businesses. Again, if you are able to make out a case that the 2 businesses are independent, according to me, conversion under 4713 will still be possible if one of the businesses is converted, and therefore this whole succession for the business becomes very important. In some cases where we had a proprietary firm which was converted under 4713, the proprietary balance sheet was all jumbled balance sheet in terms of the business assets and the personal assets. From a practical point of view, it's advisable that at least 1 year prior to the actual conversion, you should segregate the balance sheet so that the business balance sheet is separate and the personal balance sheet is separate. Again, this is one provision where there can be a lot of practical debate and practical difficulties, and therefore this one provision will require some careful planning. All the partners of the firm to become shareholders in the company in proportion to their capital balances. So while the partnership firm, the allocation of profits is on the basis of profit sharing ratios, the conversion and the amount of shares which the partners get under a 4713 conversion is not on the basis of the profit sharing ratio, it is on the basis of the partners' capital. And the condition will apply to the balances immediately prior to the conversion, and therefore if there is any restructuring that is required because your ratios, if they don't fall in line with how the promoters see the shareholding pattern, then you will have to restructure the balance sheet. One of the practical tools that are possible is that you can sort of, because in a business you will have some working partners who are not contributing capital, and you will have finance partners who have contributed a larger part of the capital, and therefore if you allot shares on the basis of the capital, then the set which is a working partner, they will get PSR of shares in the company which is lower than what is the understanding. So you could restructure your capital balances by either moving from fixed to current, and it's possible that you can allot shares. So you can allot equity shares and you can allot preference shares. So for some type of shareholders, you can allot preference shares, just to reconcile the differences in the capital. Also try and ensure that those share allotments don't result in fractional entitlement. And again, from a practical point of view, when you actually drop the balance sheet and when you are doing this whole conversion process, because whenever the date of conversion is there, you need to close up the accounts will throw up numbers which are in fractions, the profit will also be in fractions, and therefore one has to practically deal with how this conversion will apply. When the partners need to become shareholders, again there have been some case laws, and one couple of instances where we were on the receiving end is that between the date of conversion and the actual allotment of shares, there was a time gap. While we have this decision of Sanjay Singh, my practical recommendation to you is, and we had gone right up to Mr. Soli Dastu to find answers to what is the gap, because there is the relevant provision says that partners become shareholders as on the date of capital balance, as on the date of succession. If the tax authority uses the word that they should become shareholders on the date of succession, whereas our understanding is the date of succession only applies to the capital balances. But again, to just ensure that you are not caught on the wrong side, try and ensure that the share allotment happens on the date of succession. The next condition is that the consideration should be solely in the form of shares of the company. The way I would read the provision is that this is the consideration for the conversion or transfer of the business, and therefore post conversion, if there are some benefits which the company offers to the directors, should not actually tend to violate this condition. But again, one should be a little guarded in trying to ensure. So suddenly the partners were not drawing remuneration in the partnership form, and once they get converted into a company, if there are huge salary payments, tax department can allege this. While the legal answer is what I have said, but at a practical level it could create some difficulty. There is another requirement that the aggregate shareholders of the partners remains 50% for a period of 5 years. The whole purpose is to ensure that you are not using the conversion mechanism to create a situation where the ownership immediately gets transferred post conversion. Again, very detailed provisions can apply. I will quickly run through. My sense is that this 50% has to be maintained on an aggregate basis. And therefore, inter se the partners, if the shareholding changes, that should still not lead to violation. But ensure that the company and the shareholders of the company remain for a period of